Hey guys, my name's Jose, and this is another episode of Buy or Pass. In this series, I will look at the financial documents of a company and decide if I had money, would I buy or would I pass. Before we start, don't forget to subscribe to get info on new episodes and other videos. So let's begin. So like always, I'm going to use the website known as LACF.com, which allows me to see those financial numbers in an easy visual format. Today, we're going to take out a company known as SouthWest, ticker LUV. So today we're going to take a look at all the three financial sheets: income statement, balance sheet, and cash flow statement. We're going to take mainly focused on annual data, but we are going to take a look also in the quarterly data to see if there's any outliers. Right now, here we're on Southwest, and we can see based on the annual data, there has been some increase in revenue over the past 4 years, since 2000, actually since 2009. As back as we can see in this data right now, we can increase the data, but since 2009, the revenue has been increasing. This past year, 2000, end of 2018, revenue was at 21.96 billion, almost 22 billion, where last year was 21.15 billion, an increase of about $0.8 billion of revenue increase. Fortunately, cost of revenue, like always, also seems to be increasing. Last year was 6.37, this year was 7.06 billion. Important one good thing to see though is something I want to dig in a little deeper is between 2011, 2012, 2013, and 14, cost of revenue was much higher compared to what it is now. Want to see how that huge decrease happened? And that's something I'll take a look maybe in another video. Here next we can see gross profit, which is just revenue minus cost of revenue, being pretty plateau in the past 2 years. 2017 was $14.78 billion, where 2018 was $14.91 billion, an increase of only not even 200 million over year to year. Let's take a look real quick at quarter three to see if there's any outliers, and right here nothing seems to be outside the box. Next we have net income. So net income here in 2017 was a lot higher than 2018. 2017 net income was 3.36 billion, where now in 2018 is 2.46 billion, a decrease of about 1 million, maybe $900 million in net income revenue. Here I'm going to take a look at quarterly data to see if there's any outliers, and nothing seems to be throwing us off except quarter in one of the quarters of last year, 2017, there was a huge net income reported for 2000 for the last quarter of 2018, it seems, for the last quarter of 2017. So that definitely drove the huge increase in net income for 2017. So if we don't account for that, 16 to 18, there was an increase from 2.1 billion in 2016, where now 2018 2.46 billion. Earnings per basic share, we're going to see the same thing we saw in net income, where that one quarter in 2017 stands out, being that outlier and making last year such a huge earning per basic share compared to the previous years. But if we look at a slope from 15, 16, and 18, skipping 17, it looks pretty in line with how a pretty steady, healthy growth. Now let's take a look at Lacy FA has these red flag analysis. Another way for us to see the information we just took a look at. So here again, we're going to take a look at revenue versus cost. Revenue is outweighing cost. Good to see in annual. Again, quarterly, nothing crazy. Gross profit, pretty high gross profit at 14.9 billion. Again, these past 2 years seem to have, then gross profit, we see gross profit here in the past 2 years have seemed to plateau, increasing but not at a crazy rate. It's pretty slowing down from 14.78 billion to 14.91 billion. Here we have revenue versus cost growth in a percentage base. This year, revenue grew 3.8%, where cost of revenue only grew by 10%, 10.8%. Pretty high jump of cost of revenue growth compared to revenue growth. But here, it's still just another thing to notice, right? Revenue again is still outpowers cost of revenue by factors of 3. Now let's take a look at gross margin and profit margins. I like bar charts better. Gross margin, nothing crazy. A drop from 69.9 last year to 67.9 this year. Nothing outrageous, not a big drop that would should scare any investors. Here, profit margin though didn't decrease by a lot. Profit margin last year was 15.9%, where this year was 11.2%. So this gross versus profit margin, it is pretty scary. So let's see what red flags LACF is trying to throw at us. Right now, revenue strictly increasing. The LACF is triggering a flag for revenue strictly increasing. The reason it's throwing us this flag is because year after year, the revenue here has increased. Normally, in the perfect world, right, you do want to see revenue increasing year after year, but there's always, let me not say always, most of the times there's pullbacks or something that gives 1 year lower than the year before. But here we're not seeing this. Here we're just seeing straight increase of year-to-year revenue. So LACF is just telling us to be careful, to take a look at the data, ensure that data is not being manipulated with the sales or anything like that. At the moment, I don't see, I haven't dug in deep enough to really take a look at this flag or to see if this is something we should really take a look. But I do appreciate LACF for giving us that warning. All right, so next we're going to take a look at my favorite sheet, the balance sheet. So here in the balance sheets, we have total assets, total liabilities, total debt, and cash equivalents. So total assets have increased from previous year. Last year was 25.11 billion. This year was 26.24 billion, an increase of over $1 billion. Unfortunately, liabilities have increased as well from last year 15.47 billion to this year 16.39 billion, a little less than $1 billion liability increase. So at least assets number wise is increasing higher than total liabilities. Percentage wise, I think we're going to see the opposite, where liability is increasing at a higher percentage rate compared to total assets. Then we have total debt. From 16 to 17, 2016, that was at 3.39 billion. It increased in 2017 for 3.67 billion, an increase of 0.3 billion. And this past year, they reduced the debt by about 0.3 billion. Right now, it's sitting at 3.38 billion, almost in line to where it was 2016. Let's just take a look at the quarter, see if there's any outliers. Assets been increasing, liabilities also increasing. Total debt increased in the end of 2017, and it's been decreasing ever since, as the company's been paying back debt. Cash and cash equivalents is one of my favorite things to look. This is what the company has as cash or some form of liquidizable asset that can be transformed to cash pretty quick. It has been increasing over the years, and right now it's sitting at $1.85 billion, almost half of its total debt. A little over half. Let's take a look at quarter to see what's happening. This past quarter, it did reduce from about 400 million, and it's probably to help pay off this total debt. So now we're going to take a look at the red flags for the balance sheet. Again, it's just going to be another way to take a look at the balance sheet. Take a look at the bar graph. Here, total assets we can see have always been higher than total liabilities, which gives us a positive shareholder equity. Shareholder equity has been increasing Last year was 9.64 billion. This year was 9.85 billion. But nothing seems to be increasing at a drastic rate. Assets versus liability growth. Here we can see, right, assets grew this year by 4.5%, and liabilities grew by 5.9%. So growth is increasing at a slower rate compared to liabilities, which is not usually the case, but they are pretty close to each other, um, which has been what has happened in the past. Asset distribution, we'll take a look, and as we can see, assets 78%, 77.4% of its assets is property, plant, and equipment. This company has planes. That's where they make all their money. So I'm pretty sure 77%, a huge portion of it, is just all the planes they have. The next is, I just want to take a look at how much cash and cash equivalents. Cash and cash equivalents are only 7.35%. So usually I don't like to see a company that has so much equipment, but obviously for this type of business, equipment, property, and plants are a major aspects to his company. So it's not, it doesn't, it's not a bad thing to see. Next, we're going to take a look at liability distribution. Here we can see 38% of his liability distribution is on non-current debt. That's debt that needs to be paid off over a year. And I just want to take a look at current debt. Current debt is $606 million. That's about 1/3 of the cash and cash equivalents. So the company does have enough money to pay for it right now, but it's gonna definitely take a huge chunk of that cash and cash equivalent. Next, we're gonna see another thing we're seeing is just current debt here. Non-current debt has decreased compared to last year. Last year was 3.32 billion. This year is 2.7 billion. A nice drop down to see on its non-current debt. Here we do have a flag again. Here we have average liability growth outweighs average asset growth. This flag is just telling us that a majority of the times total liability growth is increasing at a higher rate compared to assets. Again, nothing seems outrageous here. They're all pretty close to each other, which has been happening throughout the year. So again, it's a flag that's triggering. It definitely got my attention, but after looking at the charts, it's nothing that I'm really focused on. Finally, we're going to take a look at the final sheet, and that's going to be cash flow statement. Cash flow statement, this company, the only thing I care about the cash flow statement is net cash flow from operations. This company has a positive cash flow of $4.89 billion this past year, an increase from 3.93 billion of 2017 and 4.29 billion of 2016. So if we're looking at 16 or 17, 2018 has definitely been a good year. And finally, we're just gonna see in the cash flow statement red flags to see if there's any red flags triggering right now, and LACF does not give me any red flags at the moment. Finally, we're going to take a look at metrics. I just really like to see price to earnings ratio, mainly in a quarterly base, to see how it is. Right now it's at a 10.8. For a company that's pretty slow revenue right now, we saw revenue is not increasing at a fast pace. That seems to be an okay price to earning ratio. It's pretty in line with the other things. So let's just take a quick overview before we decide to buy or pass. So taking a quick look again at the overview, for me, SouthWest will be a pass. I definitely would not buy SouthWest at the moment, and the main reasons for me is revenue seems to be slowing down. It seems to be more of a slow down company, right? Revenue the past 2 years have plateaued. We can see cost of revenue increase, but gross profit seems to be plateaued. Net income has been increasing, but again, not at a crazy rate. Earnings per basic share also increasing. If you take a look at the balance sheet, its total assets have been increasing, but total liabilities have been increasing at a faster rate. Total debt pretty high, and one of the major things is its cash and cash equivalents are only 3 times bigger than its current debt. I would definitely like to see current debt be high, its cash and cash equivalent be a few factors higher to its current debt than 3. So for me, Southwest will definitely be a pass. So I hope you guys enjoyed the episode. Like I mentioned, LACF makes it so easy to look at all the information, which makes these episodes go pretty fast. I am curious, would you buy or pass on Southwest based on the information we just saw? Also, don't forget to subscribe to get updates on new videos, and don't forget to check out my website at josenajarro.com. Thank you guys, have a good night, and see you tomorrow.